This is an episode focused on a hypothetical situation. Brad and I are not financial advisors of a person that has $500,000 and needs to retire. There are certainly risky paths you could take to make that work.
You make a good point. I think it really comes down to risk tolerance. Hello, everyone, and welcome back to the Wide Moat Show. I'm joined today with my co-host, Nicholas Ward. Nick, it's great to see you today.
Yeah, great to see you, Brad. Great to be here. And I guess I'll start this off by letting our viewers know this is the first ever recording that Brad and I are doing on our own. We don't have IT help this week, so please forgive us if it doesn't go well. But we've been learning this, and moving forward, we'll have help again. But just bear with us this week. But I do think we have a pretty exciting topic to discuss. So, Brad, do you want to get into that?
Yeah, well, actually, I want to start with a really quick story. This weekend, my mother asked me to come over and check out one of her townhomes, which was vacant. She's been renting it for quite a while, and I went over there with her, and it was trashed. I mean, the tenant had moved out and just left a lot of things inside that unit, and so now we're trying to help her clean it up and hopefully sell it. So this addition is extremely timely because my mother is retired. She has obviously Social Security, but she's looking to enhance her Social Security with some very safe stocks or funds. And so I'm really excited, Nick. I know you and I spoke about this last week about this type of episode, focus on really retirees or pre-retirees who are looking to build their retirement portfolio. So this hopefully be the first of many editions where we're going to help our audience build out their portfolios. So, Nick, I'm really happy you decided to tackle this subject today.
Yeah, so I'll get right into it. So this is an episode focused on a hypothetical situation. Brad and I are not financial advisors. We're not getting really into the weeds here. I'm not giving tax advice, etc. But of a person that has $500,000 and needs to retire. I looked it up. To me, that seems a little light. Obviously, I think when most people, I spend a lot of time researching retirement. This is one of my favorite videos to make because it's kind of what I do for myself, right? I keep building all these different scenarios, all these different paths to my own retirement. And now I'm just taking that knowledge and kind of putting it into the internet. But my number is much higher than $500,000. I don't think I would feel comfortable retiring with that much. I have two young kids. I need to pay for insurance, etc. So that wouldn't work for me. But I think there is a scenario where you're older. Maybe you own your home already. I looked it up. A 2022 article from Bloomberg said that about 60% of people in like the 55 plus age bracket own their home outright. So that's the biggest line item out of your monthly budget going, that mortgage payment. So, let's say we assume that's true. Then all of a sudden $500,000 becomes, more reasonable. And it's kind of in line with the averages. So I looked it up. According to Fidelity, the average 401k balance of people basically from 55 to 70 hovers right around 250K. So I'm assuming they probably have a little bit in a taxable account too. I also looked up the average net worth of people in different age brackets, and the average net worth for 55 plus is usually 1.5 to 1.7 million. However, the median is much lower. The median's only about 250K to 375K. So I guess what that tells me is that like the Elon Musks, the Jeff Bezoses of the world, their massive fortunes are really bringing up the average. But, once again, we're kind of in that $500,000. Unfortunately, I couldn't come up with a good scenario with like 250K. I don't want to hurt anybody's feelings, but if that's all you have, I'm not sure that Brad and I can really help you retire safely. I mean, there are certainly risky paths you could take to make that work. But I think with about 500K, it's doable. So that's what we're going to talk about today. I have 3 different ways that, you could consider going down that path. And I'll break those down in detail moving forward. But I guess before I do, Brad, do these numbers kind of make sense to you? I don't want to get into your mother's finances. That's obviously her private business here. But, what do you think? Is your target number much higher than this? Do you think, hey, you got about $500,000, you've got your mortgage paid off, you've got Social Security, you can do it? Kind of where do you lie on this possible retirement, scenario.
Yeah, Nick, I think that's a great point. And I also want to point out, first off, that for folks watching that only have 250,000 or maybe even 50,000 or maybe even $5,000, we have a product called the Wide Moat Letter. It's available at widemoatresearch.com. And this product helps you build and aggregate in your portfolio so you can get to 250K and eventually get to 500K. And we do all that heavy lifting for you. And that's the whole purpose of the Wide Moat Letter. So whether you're a 500,000 net worth investor or $1 million or multi-million-dollar investor, we have the smaller investors too. So, it's not, I want to make sure this is extremely important. So yeah.
Yeah, no, that is a great point. Yeah, to be clear. So we offer model portfolios with our paid services at the Wide Moat Letter, at the Brad Thomas Confidential. Those are different from what we're talking about today. This is just a hypothetical kind of YouTube scenario. I've seen other financial content creators do these very similar videos, 500K, 1 million, 2 million, etc. And people seem to like it. I think it's fun to watch. So we're doing that this week. Excuse me. And like Brett said, if you don't have 500K, we can help get you there, right? Once again, we're not advisors. We don't tell people what to do with their money, but we do publish model portfolios that have outperformed the market over the long term. So
yeah, and I want to give Nick a shout out here because I don't give him enough shout outs here at the Wide Moat Show.
Oh, there we go.
Nick is the portfolio manager for the Wide Moat Letter. And I was telling an investor this morning who also is a very smart investor. He went to UVA just like Nick. And I was telling this investor that he said, well, tell me about your track record. And I said, well, we've had a really good track record. But I said, here's what most people don't really know is that Nick has never had a pick in our portfolio where we've seen a dividend cut. We're 100%. We're 100% in terms of our performance. We have never had a dividend cut yet. And Nick, great job with that, because that really is the ultimate way to sleep well at night, or what we call SWAN investing. So kudos to you, Nick. And so let's get started and dive into how we're going to build this portfolio.
Yeah. So I appreciate that. Yeah, I take a lot of pride in that. Anybody that knows me knows I love dividend growth investing. And obviously you can't have the dividend growth if you're headed in the negative direction. So here's kind of how I think about it. So with $500,000 and you want to get to, about 5K a month, right? That's our target for this video. So without Social Security, that's a 12% yield, which is pretty difficult to get to, especially when we're talking about, excuse me, I have a frog in my throat, in the income funds. Brad and I love the idea of not touching our principal, our capital. We'd like to just leave that there, let it grow, live off the interest. And then that way you never have to worry about, you're in a race against time, drawing down your money to zero. When I'm in retirement, when I'm no longer making money, I don't want to have to worry about, are we going to draw down our savings? Am I going to work my whole life, create a nest egg, and then I'm just racing to hopefully die before it goes to zero? That's not a scenario I want to be in. I would much rather just let my principal grow, live off the income, and then I can have a bunch of money to give to my kids, to give to the church, to give to charity, etc. when I die. I kind of imagine on my deathbed that'll make me feel a little better about my life looking back. So with that in mind, there's two scenarios that you can have with that 12% yield. One is you have to find 12% yield paying something, live off that income and draw it. And really there's not very many options there that are sustainable. I would probably argue there's zero. I think like the QQQI, that's the NEOS NASDAQ 100 high income fund. They sell covered calls against the QQQ. It's pretty volatile. So they can generate, a lot of income. Right now, here's some information. They have a 14.3% yield. So theoretically, you stick your $500,000 into QQQI, you get a 14% yield. You're able to take your $5,000 a month. You're even able to reinvest a little bit. And that's great. But the problem is these aren't dividends. This isn't Johnson & Johnson that's just going up and to the right. That's raising that dividend every year. These are options premiums. They have to do with market volatility. And if the market falls 30%, the income that you get from a product like QQQI is also going to drop, probably about 30%. They kind of target that 12 to 14% range per year, but that's based upon where the NASDAQ sits. So if you think the NASDAQ's going to keep going up, then that's great. This fund will get you to where you need to be. But the problem is, what if the Nasdaq's down 30%? Then all of a sudden you're getting $2,800 a month, et cetera. I didn't do the math because I don't really think this is a good idea. So I didn't put a lot of effort into this path, but there's one path. And then on the kind of the flip side, what if you are willing to draw down your resources? That's not what, Nick Ward wants to do, but that's what a lot of people like to do in their retirement. That's their plan. They get a big nest egg, they let it grow every month, they sell whatever they need. And then over the long term, as long as it's growing at a rate that's faster than you're selling it, you're going to be okay. So I looked at, to me, when I think about 12% plus growth, there's only one kind of easy way to get there, and it's technology. So I looked at the QQQ, and I'll put up some charts here. And as you can see, in the last 3 years, it's up like over 20%. So you're doing great, right? In the kind of the AI age, the QQQ has done just fine. This is a highly diversified 100 stock index. It'll get you there. But since inception, it's only at about 10%. So that's not going to work. I looked at the XLK, which is just technology, and we'll put up holdings, the top 10 holdings for the QQQ versus the XLK, and you'll see there's some overlap, but they are different. And then they've done a little better, but still over the long term, they've actually done a little worse. So in the last 10 years, they're averaging 20%. You've done great. Your nest egg has grown. You've been taking your 12% a year, and you've got more money than you started with. That's the ideal retirement scenario. But technology doesn't always work. During recessions, during big market drawdowns, you're going to have problems. And that kind of gets this sequencing risk of, that's what I want to avoid. I don't want to have to take money out of my portfolio when the market's down 25%. I know that's going to feel horrible. So instead, I would much rather go a route where you don't have to do that, where you just, draw the income. And then the only other thing I would say in this, I did look, there's a Mag 7 ETF. So if you look at these top 10 holdings and you're like, well, I'm missing Nvidia or I'm missing Tesla, et cetera, whatever you want, there is a Mag 7 ETF, which is newer, but it has outperformed both the XLK and the QQQ. So maybe that's your strategy. You say, I'm going to own those 7 dominant companies, and I'm just going to rely on them for my retirement. And I think that's like probably an okay plan if you have high conviction. But to me, it's not well diversified enough, and it doesn't give you cushion. It has the same sequence risk. You still have to sell. If the Mag 7's down 30%, you still have to sell your stocks to raise your money. So I guess, Brad, so what I did create a more customized portfolio, and that's what we're going to get into now. But Brad, before I do that, I mean, do you have thoughts? I think I know how you feel about retirement. I think you kind of share my fear of having to sell those assets to pay your bills. But, any thoughts on the kind of tech or the high yield path? Would you pursue those, or would you look for something else?
Well, Nick, I got to say, I mean, I've been on Seeking Alpha for 16 years and written over 5,000 articles. So I have, I don't know, 80,000 or 90,000 comments. A lot of these comments are, and 120,000 followers are retirees. So I interact frequently with retirees. I will say that, technology is a scary space. I believe that most retarees, including my mother, who I mentioned earlier, would really rather have just an income focused portfolio and not have to draw down capital and live off that principle. However, you make a good point, and I think it really comes down to risk tolerance. I mean, every investor, whether you're retiree or not, is going to have their own risk tolerance. You have got me, Nick, more interested in technology than I ever have been, even when we work together at Seeking Alpha. I've become a lot more knowledgeable in the space, but also think it's definitely a sector that investors should be investing in. The question is how much of that. And so I look forward to...
I agree. And the answer is not 100%, right? In no scenario would any financial advisor, would any professional in the industry say, go 100% XLK, right? So that's why I said, that's not ideal. But when you have to get 12% returns a year, that's a pretty high bar to clear. That's above the S&P's long-term average. That's above the Dow Jones's long-term average. So, that's the problem with having a potentially smaller nest egg. If you only have 500K to work with, you're going to have to take some risk somewhere, I think. But I have tried to kind of fix that with our customized portfolio, but I cheated. And here's how I cheated is, we're not getting $5,000 a month with this portfolio. We're only getting 3,000, and that's because I'm letting Social Security help me here. The average Social Security payment in 2026 for Americans is $2,076. So I went ahead and subtracted that from the $5,000 target. We're going to use Social Security to our benefit here. If you're not, if you're only 50 years old, you're going to have to come up with something to bridge the gap here, maybe take a little bit more risk. But if you are in the Social Security range, then you only need about $3,000 a month to hit this theoretical $5,000 a month target. So with that in mind, I was able to kind of balance it out. So Brad, what I did was I divided the portfolio into 3 different baskets. I have the SWAN basket, sleep well at night, risk-free. That is short-term U.S. government bonds, ticker symbol SGov. That is roughly, I allocated about 10% of the portfolio to that. And the reason being is when the market is down 20%, 30%, etc., I would sell this position and I would go buy the other things that are beaten down, right? Because this should just basically stay about the same. You're not really ever going to lose money in SGov, unless the U.S. government crumbles. And if that's the case, then we have much bigger problems than retirement portfolios. But the problem is it only gets about 3.5%, 4%. So your risk is very low, but your reward is also very low. Then I created an income basket, which is the vast majority of this theoretical portfolio. This is where we're generating our yield to live off of primarily. And then I added in a growth basket at the end because, like I said, those higher yields are oftentimes volatile. They're not always sustainable. So, they kind of fluctuate. I did look like QQQI in March of 2024 was paying 60.45 cents a share dividend. And in March of 2026, it was 60.89. So it's up slightly, which is wonderful. But the point being is it has been fairly stable. So maybe I'm underestimating the fund managers and EOS. Maybe they can do it. But I would like to have some growth. So what I did was I added some dividend growth funds to now their payments are relatively small. We'll put up a spreadsheet here showing the portfolios, the theoretical shares owned, and their incomes. You see the incomes on this growth bucket are lower, but I do think those funds will grow their dividends at about 10% a year. So in 7 years, all those numbers will be twice as high. In 7 years, I expect the numbers on the income bucket, they're going to be about the same. I don't expect a lot of dividend growth from that bucket. So where you get your inflation hedge and your kind of purchasing power protection is from this growth bucket. So, like I said, the portfolio is up on the screen and here it is. So we have roughly 50 grand into SGov. It's going to generate you about $2,000 a year, very safe income. Like I said, in a market crash, I would, if it was me, I would sell this position and reallocate it towards beaten down risk assets. And then when the market goes back up, you could sell those assets at a profit and then go back into bonds. You just go back and forth. You kind of, my personal portfolio, my bond, this is my cash, basically. I can't have cash generating $0. It's got to be doing something for me. I keep it in something like SGov, and I trade in and out of it based upon kind of where I think the market's going. In the income bucket, we've talked about a lot of these before. We have the Reeves Utility Income, CEF, UTG. Wonderful, company. It's a CEF. Here's their income, their distributions. It's always up and to the right. It's slow growth, but it's up and to the right through some pretty volatile economic times. So Brad and I both love that. We both kind of vetted this before. We like the holdings. We talk about AI all the time. What does AI need? What do data centers need, et cetera? They need electricity. Well, here you've got that covered. I've got the Goldman Sachs and the NEOS S&P 500 and QQQ, the NASDAQ covered call ETFs. These have a little bit different strategies, different fund managers. So I think by spreading kind of your risk across the 2 fund managers makes sense here. Maybe NEOS is right. Maybe Goldman Sachs is right in any, 6 to 12 month span. That way, if they make a terrible mistake, you're not losing everything. And then I did add in the NEOS gold. You have some gold exposure in this portfolio. I know not everybody loves gold, but it has been pretty volatile this year. So that allows these NEOS guys, which this fund, the IAUI, that won the 2025 income ETF award for like the best new income ETF last year. Generates about a 10% yield, gives you some gold exposure. So if gold goes higher, the NAV, the NAV of this fund should move higher, and they're generating income selling cover calls along the way. So I guess I'll stop now, Brad. There's my income basket. It's one CEF, 5 ETFs, average yield, about 10%, probably actually about 11, 12%, because the NASDAQ funds do generate, 10 to 14% yield. So You can see the income on the right side of the screen there. It's these 6 funds generate you $27,500 in annual income. So, this is where in 2026 with this portfolio, the vast majority of our money comes from.
Yeah. So Nick, I guess my only question here is, of course, you probably know what I'm going to ask you, but I don't see any real estate in this basket.
I thought about it. With that extra, I had $20,000 left over, and Neos does a real estate fund, the IYRY. It basically tracks the real estate index, and then they do the same thing. They own it, and then they sell covered calls against it. It has a higher yield than the gold. So if you want an extra $500, you could get rid of the gold, put in the IYRY. The problem is I was looking for a REIT like Realty Income. I would love to have room for that in this portfolio, but with this $500,000 threshold, we don't have room for like a 5% yield, unfortunately. In the future, we said, we hope to do the $1 million example, the $2 million example. I suspect that those portfolios will have a lot more real estate in them. Like I said, it doesn't get any more reliable than Realty Income. That's going to be a big part of my personal retirement, but the yield was too low, which is kind of crazy to say. We're saying the yield of Realty Income's too low. That's hardly ever the case, but when you're trying to generate a 7.2% yield, you can't have too many yields that are below that. And Realty Income's growth is just too low. So yeah, I thought about going the IYRY instead of the gold, but I knew that a lot of people feel pretty comfortable. Like they want to have some gold, right? So gold would be about a 5% allocation to this portfolio, which I think kind of makes sense. Like if you're going to hold some gold coins or something, I think it's okay, 3 to 5%. So that's where I went. So sorry, no real estate. I thought about it. I knew you would ask that question, but I think that's going to have to be in like the $1 million retirement scenario.
Yeah. Yeah. Well, I would prefer to not, I think that's wise. And again, I wouldn't be chasing yield in the REIT sector and having some of these mortgage REITs, which we know are toxic. And we've talked about those a lot, these sucker yields. So I think you're right. Just keeping it really safe and keep it simple, stupid.
Yeah, like I love REITs, and Brad and I, we've got our favorites. We have a REIT portfolio at the Wide Moat Letter, but those are 4 to 6% yields most of the time.
Yeah,
and then they give you total return because the fundamentals grow, but the fundamentals aren't growing as much as these growth ETFs that I have below. So then we have the Vanguard Dividend Appreciation ETF, VIG. We have the iShares Core Dividend Growth ETF, DGROW. We have the Schwab US Dividend Equity ETF, SCHD, and then the Amplify Enhanced Income Dividend Fund as well, DEVO. So these are the top 3, VIG, DGROW, and SCHD, kind of all do the same things. Their managers pick their favorite dividend growth stocks. They allocate them however they want, and then you generate yield. VIG has the lowest yield. SCHD has the highest yield. Kind of as you would expect, VIG has the highest dividend growth. SCHD has the lowest dividend growth out of these funds, kind of on an expected forward basis. But, I still like all 3 of these names. I'll put up their top 10 holdings here, and you can see there's a little bit of overlap. But if you own these 3 funds, you own basically every wonderful dividend growth company that there is. Except for real estate, unfortunately, because it looks like most of these funds don't add in real estate. For whatever reason, a lot of these I think it's because real estate didn't become its own sector until like fairly recently. Before then, that was kind of its own alternate area of the market. But it would be interesting to see, a lot of these funds have rules, like a company has to have paid a dividend for 10 years, or it has to have grown its dividend for 10 years, like in the case of VIG. That they add in REITs, because that would bolster the yields of these shares, of these ETFs. So it'll be interesting to see if they do that moving forward, but even without it, it's fine. These have 2 to 3% yields. They're growing at about 8 to 12% a year. So I like that a lot. And then the Amplify Enhanced DEVO, that's an interesting thing. They only own about 26 holdings. So they're an actively managed fund. Their managers pick the best dividend growth stocks, and then they sell covered calls, but only against like a small part of the portfolio. So that's the difference between like a GPIX or an SPY. Those guys sell covered calls against like 80, 90, 70% of the portfolio. They're really capping their upside by doing that. Devo doesn't do that as much. Devo just kind of picks and chooses their spots. They're very actively managed. So, they do cap a little bit of upside, but most of those funds are just able to grow. So as you can see here on this chart, there's the total return versus the S&P 500 and versus the other dividend growth ETFs. And Devo actually has the best results. So I really like their management team. They've done a great job with using options leverage to bolster results, which is what options are for. A lot of people see these ETFs and they just think you're trading your upside for income, which is the case if you sell right at the money calls. But those guys, they sell out of the money calls. They pick and choose their spots. I really like Devo. I own it personally. And, it's going to be a big part of my retirement. So I felt like it should definitely be added in here. And unlike these other kind of 2 to 3% yielders, Devo has, 5 to 6% yield. So they're able to double the income they produce by using options. But anyway, so there's the whole portfolio. The portfolio is valued at $499,970.04. It generates $35,812 per year. That's a 7.16% yield. That's $2,984 a month. You add that kind of, average Social Security check, and there you are at $5,060 a month. So Brad and I talked about this kind of theoretical scenario. What would you do with $500K if you were trying to get $5,000 a month? Here's probably how I would do it. I would go ETFs because it allows you to stay diversified. We have exposure to probably about 1,000 different companies, or at least hundreds with these funds. But the problem is with only 500 grand, you can't get super diversified. There's no international here. There's no REITs, like Brad mentioned. There's only 10% exposure to bonds. There are no preferreds. I thought about adding preferred. So, I think we'll do $1 million soon, and then that'll, Brad and I can get a little more fancy with that, but there will be more than, 10 funds. But you gotta keep it simple, stupid. If this is your plan, I think, and this is how I would do it. So Brad, my throat's hurting with 24 minutes in. This is the lecture I'm giving on retirement. So I'm going to pass it over to you for final thoughts. And I guess I'll say, please leave, questions and comments below. Tell me if I'm smart. Tell me if I'm stupid. Tell me how you would do it. And let us know, what kind of target monies you would like for us to do these kind of theoretical scenarios in moving forward.
Yeah, no, this is great. And let's go ahead next week, Nick. Let's go ahead and do the $1 million next week. I'll certainly weigh in. We'll have some REITs. We may have some energy names in here, maybe some asset managers, what have you. I think we should really build out a more diversified basket next week. So we'll look forward to working with you there. I think this is a great start. I think, having that amount of capital to invest, I think is a really smart way to do it, Nick. Thank you for this edition. And we'll just cut it short. Look, this is our first show without help, and we're under 30 minutes.
I think we did it. I think we did. We made it through the show, 25 minutes. Right. You know what, Brad? We're wrong. That we cut it.
Oh, yeah.
So we're probably at about 30 minutes. But that's okay. It's a good episode. We made it through. Let us know what you think. How's the production on this one versus normal? And we'll see you guys next Thursday with the $1 million episode, which I think will be much more diversified. It's a lot easier to build a portfolio with a 5% yield than it is a 7% yield. That seems silly. We're only talking about 2%, but it makes a big difference. So I'm looking forward to that one, and I hope you are as well.
Great. Thank you, everybody, for watching, and have a great week.